When the 4.2 inflation rate in April surprised everybody, we know inflation is here. As an investor, how do we invest if inflation keeps going up? In this video, I'm going to explain why this time is very different than 2008. In other words, we're going to have to understand why printing money in 2008 didn't cause inflation, but this time there might be substantial risk in a surge in inflation in the second half of this year. Then we're going to talk about how to invest in this inflationary environment. We're going to take a look at different asset classes and some financial instruments you can use to hedge against a surge in inflation. Without further ado, let's dive right into the video. Inflation didn't just come out of nowhere. It first happens with an incident that disrupts the economy, causing people to lose jobs. This is the pandemic. Then monetary policy and fiscal policy was forced to be called out to revive the economy, at the same time causing imbalances in the economy. In 2008, what we had was a financial crisis. The problem mainly occurs in the financial system and the real estate sector. The printed money was mainly used to fill the hole in the financial system. Not much was flowing into the actual economy, so we didn't see much rise in actual prices. But this time, in order to fight COVID-19, money was created and handed over to the government to issue pandemic checks, fund social welfare programs, and infrastructure plans. Money flowed into the actual economy. At the same time, we have a red-hot economy and a slow rebound of supply. The inadequacy of most governments in the world to shut down the pandemic slows the recovery of the supply side of the economy, causing commodity prices to rise sharply. The recent jump in CPI surprised the market, but CPI is a lagging indicator, meaning it measures something already happened. How do we know inflation is going to keep going up? Purchasing Manager Index, or PMI, provides information about current and future business conditions. When it's above 50, the economy is expanding. When it's below 50, the economy is in contraction. In economics, it's called the leading indicator. You can think it predicts what's about to happen in the economy. PMI takes into account new orders, output, employment, supplier delivery time, and stock purchases. Because the economy is recovering from the pandemic, we're currently having a red-hot economy filled with new orders, rising GDP, not at all full employment, slow supplier delivery time, and businesses building up inventories. This combination creates a PMI that's over 60, 10 points above 50. Last time PMI was this high, it was in 2004 when the economy was taking off after 3 years of recession following the dot-com bubble. The current environment is showing lots of signs of late cycle behaviors while we're still in recession. Another indicator is inventory to sales ratio, which is at a historical low level since 1992. It compares how much inventory you have in the store to the amount of sales you have. If you don't have enough stocks and customers are demanding more of your products, meaning sales is high, it could drive up prices. Over the past few months, I devoted a fair amount of effort discussing the risk of inflation. This video takes you on a journey through the 2008 financial crisis and explains in detail why inflation is not a simple result of printing money. This video talks about how fiscal policy and mismanagement of monetary policy created the hyperinflation in the 1970s, and how today shares a lot of similarities to the 60s. They're included in the inflation playlist. I strongly recommend you guys check them out so that you get a thorough understanding of inflation. Now that suppliers are raising prices, businesses are raising prices, we can have reasonable confidence that inflation is here and could potentially be even higher. The next question naturally comes to, how do we invest in this kind of inflationary environment? A natural reaction in the financial market to expected rising inflation is a rise in interest rate. So in terms of investing, what we're trying to achieve is shift to assets that's going to be benefiting from nominal GDP growth, but not so much harmed by a retraction of liquidity. First of all, I'd like to share my thoughts on what to avoid or what not to invest during inflation. Because stock is priced based on infinite projected cash flow to the future, These cash flows are extremely vulnerable when rate rises higher than expected, which is the scenario we like to hedge in this environment. The stocks that are particularly exposed to this kind of problems are technology stocks with unreasonable valuations, such as Tesla, NIO, or Canon. At times, good companies are not good investments. In fact, any stocks with a ridiculous valuation that cannot be adjusted by its growth had better be avoided. Traditionally, you're going to want to hold stock and bond to hedge against each other. When stock falls, bond rises. When bond falls, stock rises. But that's the case when there's not much inflation. In this environment, surprises in interest rate is more to the upside. So you may want to hedge by buying certain stocks and short bond at the same time. Because long duration bond is going to be impacted more by the rise in interest rate, shorting long duration bond provides a good hedge in this rising rate environment. Some instruments you can use are inverse bond ETFs such as TBT or TBF or TBX. Beware that the longer the duration, more volatile the ETF. For example, TBF, which shorts 20-plus year treasury bond, is going to be more volatile than TBX, which short 7 to 10 year treasury bond. Also be aware that the X is here. This means how much leverage the fund applies. For example, TBT applies 2 times leverage. It means its volatility will be twice as much than it didn't apply any leverage. I will paste the link to this page in the description so that you guys can check it out. Or a more direct way is to short bond futures. Back to stocks, some people are afraid that when rate rises, stocks will certainly go down. Actually, that's not historically true. This environment doesn't provide much beta opportunities, meaning investing in index funds, you probably shouldn't expect a lot of return. Instead, you may want to be very selective in your stock positions. Remember, we want to invest in assets that's going to be benefiting from nominal GDP growth, but not so much impacted by a retraction of liquidity. This means stocks with high projected growth rate and lower valuation. Here I'm going to show you a chart describing the performance of the Nifty 50 during the hyperinflation in the 70s and its negative correlations with PEG. PEG is the price to earning to growth ratio. It measures how much a stock is priced relative to its projected growth rate. If PEG is less than 1, the stock is valued below its potential growth rate, which is what we prefer. As you can see, if stock PEG is less than 2 at the end of 1972, most stocks had a positive return during the period of high inflation from 1973 to 1979. If PEG is greater than 2, the stocks were more likely to have negative returns. This provides a starting point for you to select your stocks. Then you may want to make sure the stock you choose are in good financial standing. For example, current ratio is greater than 1. Make sure the company shows proven track records of sustained growth, high projected earnings growth rate. Also make sure the company is able to generate a decent return to you as a shareholder. One indicator you can use is the return on equity ratio. Ideally, this will give you a list of companies to further look into. One of the websites I use to do stock screening is finbits.com. It's completely free. You can select your criteria and the list of stocks will be shown below. You can switch between different tabs to view the company's statistics. Hopefully this helps. A final point I want to touch on is commodities. In my previous video and this video, I was talking about oil and copper futures and how they were good opportunities. Now circumstances might have changed a bit. Remember, market is pricing in marginal information. Previously, market was pricing in sustained high liquidity supported by the Fed. Now that the Fed may realize they underestimated the pace of the coming inflation. So the Fed may be pulled along with it to retract liquidity earlier than the market expected. This acts as a gravity to commodity prices. Commodity prices might still be supported by a buildup of business inventories in the second half of this year, but there's some risk in commodity prices in the immediate future. So unlike half a year or a year ago, now you may want to take a short pause in commodities, invest based on future data and Fed reactions. To recap, in this video, we discussed why 2008 financial crisis didn't cause inflation, and this time might be different. We talked about what financial instruments you can use to hedge inflation, for example, shorting long-duration bond, buying low PEG growth stocks. Finally, we talked about the risks facing commodities in the near future. Hope you guys enjoyed this video. If you have any questions or comments, please leave it down below. And don't forget to hit the like button if you find this video valuable. It took a lot of courage out of me to make this kind of investing video, but I urge you, please do your own research before making investment decisions. And last but not least, best wishes to you, my friend. I'll see you soon.